Hey, hello guys. You are welcome to another episode. My name is Sunday Gay. You are welcome to my YouTube channel, Having Forex. Like I promised us, this is a channel that I created based on the hurdles and the stress I went through, trying to acquire this skill of becoming a forex trader. It was not a smooth journey for me at all. But after everything, I came out very, 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 very uh, good at what I do. And I thought it wise that I should share this knowledge with whoever that is interested in trading forex. You know, it's a skill that is worth doing, guys. I must tell you guys. It's something that is very easy, simple. All you need to do is acquire the skill, get the basics, the fundamentals, practice, and you just see yourself becoming a professional in the field. Yeah, if you are new to my channel and if you have gotten value so far with the previous videos I've already uploaded, please share, like, and drop a comment if you have any comment. That will enable me, improve the more. I promise I'm going to be giving you guys the real thing that you need to learn so that you can become profitable in the financial market. I'm not just going to be giving you guys stories, no, but the real thing that you need to know that is required for you to be a forex trader. Once you acquire this knowledge, you can trade any financial market, be it crypto, indices, futures, shares. You can trade any forex market. You can perform very well and become profitable. Hence the need I created this channel, to feed you guys with the real thing that you need to learn, you need to take in, and once you apply it in the financial market, I tell you, I promise you, you become profitable. Having said that, today we are going to, continue from where we stopped the last video. We talked about different type of markets, different type of market structure. I have given us the trending market. In trending market, we have the two types, the uptrend and the downtrend. Then now we have the ranging market. That is the beginning of the topic of today, the ranging market. I told you we have type of market. We have the ranging, the trending market. We have the ranging market, and we have the choppy market. So I've already furnished us with the information regarding trending market. I told us that we have trending market, uptrend and downtrend. Today we are going to be talking about the ranging market. Ranging market. Ranging market. In ranging market, you trade from the bounce. What do I mean by trading from the bounce? For example, look at this graphical representative of trend here. This is what we call ranging structure. It's a ranging structure. Why is it ranging? From here, it make a swing to this level, to this support level. It bounced from here to this side. From here again, bounce to this side. Here, it just do what we call consolidation. After a while, it bounce to this place. You can see, instead of this trend now to get to almost this place, no, but it got to this place and it returned and went down again. It got here and it bounced again like this. It kept on bouncing up and down. So when you see a structure like this and you know that you are just a beginner that is not that professional in the field, all you need to do is stay away. Because by the time you enter wrongly, the trend will, price action will stock you out. It will hit your stop loss. You know, remember I told us we have what to call the entry level, the target level, and the stop loss level. I'm going to treat that. It's a separate topic on it, so I'm going to treat that as we get to that level. So in a ranging market, we trade. How do we trade ranging market? We trade from the bounce. Like from here, for example, from here, I can enter from here. With my knowledge, I know that this is the level where it will get to and it will bounce, it will come back. So once I enter from here, I exit from here. Once I enter from here, I exit from here. So that is how you trade from the bounce. That is the reason why you need to learn how to draw what we call trend lines. Trend lines. You need to learn how to draw support and resistance line. So I'm going to also teach us that once you get to that level, once you are able to draw the support and resistance line, you will know where the bounce is located. So in ranging market, you trade from the bounce. Ranging market is a type of market that moves sideways and drifts to the right horizontally. So it just move like this, like this, like this. You just see it going sideways. That is what we call ranging market. It's different from trading market. Remember, trading market, you start from here like this. It will go like this. Impulsive move, retracement, impulsive retracement, impulsive retracement, impulsive retracement, impulsive retracement. You will just be going up. Why the down one, the downtrend will come impulsive retracement, impulsive retracement, impulsive retracement, impulsive retracement, impulsive retracement, like that. You see, it will just be going down. You know, the ranging market moves in a horizontal form where buyers and sellers just keep knocking price back and forth between the support and resistance level. Like I explained to us, if you draw your support and resistance line, if you are able to draw it, you discover that the bounce, the ranging market just fit into between the support and between the resistance and the support. It's just going up, down, up and down, up and down. So it bounces. So if when you want to trade it, you either enter from the downside or you enter from the top side. But for you to know where the exact point where you are to exit, that is where knowledge and the skills comes in, so that you won't get stuck out early. That is how it is. Trading ranging market is completely different from trading market, because when the market is ranging, it creates equilibrium. Buyers are equal to sellers, and there is no one in control at that trading period. So you just go up and they will knock it up, knock it down, knock it up and knock it down. So what does that mean? The price will just shoot up, it will go down. The price will go up, it will go down. Like I told us, all these candlesticks that you see represent price action. Price action. If price is going up, you see if the currency is increasing, you see trend going up. If currency is decreasing, you see trend going down. So this will continue until the ranging market will continue until the range structure breaks out and a trending condition starts to organize. For example, you can see it goes up and down like that. Here, there was a break of structure. This is a structure. This you see is from here the support, here the resistance level. But once you see that the price action try to break through, you just be very alert because change of structure is about to happen. That means it's either it's trying to go bullish, or if it comes down and break the structure downside, meaning that the trend is about to go bearish. Now, you don't just hop into the trend because there is a break of structure. You need to wait for what we call a retest, because it will break out, then you come back to retest. Price action will come back to retest that same level. For example, if price decide to break out like this, it will go up a little bit, it will retrace back again to retest this level. And once you finish retesting this level, then you will see it going bullish again. I tell you, at that point, you see pattern. You see pattern formation. You see a rejection, what we call a pin bar formation, or you see bullish engulfing bar. Bullish engulfing, you see a bullish engulfing candle, or you see a hammer, or you see a morning star, like I've told us. So once you see it there, you just hop into the trend and ride with the trend. So that is how it is. So what you need to note is that once there's a break of structure, you wait for the retest of that same structure. It will break the structure high, break the what you call the resistance level. It will break the resistance level. It will come back to that same resistance level and retest it. As soon as it moves and starts trending up, that level now becomes a support level. So that is how it is. This will continue until the range structure breaks out and the trending conditions start to organize, like as I have explained to us. Because the ranging form does not last forever. It will get to a point that price action will break through it. But be very mindful, don't hop into the trend as soon as it breaks out. Because once it breaks out, it's coming back to retest. And be very careful, there is what we call false breakout. If you break out just to fake you, you jump into it and it will continue coming down, because the ranging market has not yet ended. It will give you a false breakout and you hop in, it will stock you out. That is how it is. The best buying and selling opportunity occurs at the key support and resistance level. Like I told you, you trade from the bounce. I've already given you what the easiest way to understand it. You trade from the bounce, resistance and support. You don't just hop in, and be mindful of where you are supposed to exit. So the best way to trade a ranging market is to wait for the price action to get to you at the support or resistance level before placing your entry to sell or buy. Once you open your chart, you will notice because you have already acquired the skill to be able to recognize that this is not an uptrend, neither is it a downtrend. It is a ranging structure. Once you see that it's a ranging structure and you have identified, that is the condition first, you have identified. The next point is for you to wait. Let's assume you open your chart and price, you see price start going up like this, and you have already mapped out your structure, your resistance and your support. Because that is the first thing you need to do before you start thinking of placing a trade. You have to wait, be patient enough for this price action to get to this place. As soon as it's planning to come down, you see price action give you a formation to come down, then you will now place a sell, make a sell entry. You will sell. As soon as it gets to this place, you exit, then you are planning to buy as the price action keeps going up. So it's like that. You wait, be patient enough for the price actions to get to your level. You see it at this level, don't jump in. Wait patiently for it to get to the area of value, as we call it, before it will you enter and the price will now start coming down. So you just ride with the trend. So you have another one, what to call choppy market. Choppy market. Choppy market moves sideways in a very small and tight range. You see, this is what the price action was, you see, the price action like this was bearish at a point. This place you see here, this is what we call choppy market, when the market is choppy. You see, it's just up and down, but in just, you cannot even place any trade. So don't even try it, because if you try it, as soon as you make an entry, it will come back and push you out. So if you jump into this type of trade, you are going to lose money. Don't ever trade choppy market. So anything, once we are able to identify that it's a choppy market, you stay away. If a market is choppy, in my opinion, it is not worth trading. It is advisable to stay away when a market is choppy. Like I always told people, when you have identified choppy market, you stay away. Just wait until the current trend tells you otherwise. If it breaks out and you see a trending market, then you can decide to buy. But if it continues like this the whole day during your trading period, I advise you to just shut down your computer and go jogging or go and do anything, another thing else, or go and have time for your family, play with your family and all that. Do, you know, just allow the structure to break out, then before you can, make a trading decision. But if it continues the whole day like this, because there are situations where the price action will just remain like this for the whole day, just forget about it. You just know that that day is your free period. You don't need to trade, so that you won't lose your money. It's advisable to stay away. So choppy market moves sideways in a very small and tight range. Small and tight range. It does not even go up, and that is just like this, choppy like that. So you stay away. How to trade trending markets? Because when a market is trending, you should know how to trade it. When a market is trending, you should know how to trade it. You don't just jump in, you know. If you can identify a trending market, it will be easy for you to trade it. Now, bullish market, you will look for a buying opportunity because you are to trade with the trend. When the market is bullish, when you see a trend, bullish trend, what you should be looking for is buying opportunity alone. Buying opportunity alone. But by the time you get to a professional level, you can always counter the trend. What do you mean by that? Countering the trend, meaning that once there is a retracement, for example, this is a buying opportunity. Price action is going up. As it gets here, you exit. That is trending market. You enter from here, you exit. Then you give room for retracement. You have the impulsive move, then the retracement. Once it retraces, there is going to be an impulsive move. Then you buy. But if you are so professional and you know what you are doing, as soon as you take your profit here, you enter again to sell to this place. But how do you know where the exact point where the retracement will stop? That is why we have what we call Fibonacci retracement tool that you can use, because statistics has shown that a pullback or a retracement, it can retrace up to 50% or 61.8 or 38 point or the level of 38 points. You know, the 50% retracement is what we always use, you know, to counter trend, to trade what we call counter trend. It makes an impulsive move. As it retraces, you place your entry here, then you exit here. Then you wait for another opportunity to buy. So it's like that. Bullish market, you will look for a buying opportunity because you are to trade with the trend. Then the bearish market, you have to look for a selling opportunity. Now, as it is here, you see from here to this place is an uptrend. From here to down to this side is what? A downtrend. We got here, then there was a change of character. Now down to a bearish trend, now continue. So this is an impulsive move to the downside. This now become a retracement. You know, if the market is bearish, if the trend is bullish, the impulsive move is this way, the retracement this way. But if the market is bearish, impulsive move is down like this, the retracement is like this. So you enter here, you exit here. You allow the market to retrace. You know, you enter sell again, you follow the trend, you exit and allow the trend, the price action to retrace. So that is how we trade it. Like I said, if you have gotten to a level that you are very, very, professional in the field, after a very long time or practicing, you can even trade the retracement. It's like that. Because the retracement is an opportunity too for you to buy and make money. So it's like that. But the question is, when is the right time to enter a trending market? But I've already explained, but let me just still go through it for you to understand. The right time to enter a trending market. Trending markets are characterized by two important moves. We have the impulsive move and the retracement move, like what I have explained to us. Impulsive retracement, impulsive like that, retracement. But this one here, we have the impulsive retracement, impulsive then retracement like that. So they are characterized by two moves, impulsive retracement, be it bearish or bullish. Professional traders understand how trending market moves. So what they do, they always buy at the beginning of an impulsive move and take their profit at the end of that impulsive move before retracement will start. That is how professionals trade. You make an entry at the beginning of an impulsive move, then you exit at the end of that impulsive move before the retracement will start. That is how professionals trade. But don't worry, you gradually you get to that professional level. It's a matter of time. Spend time, reading your the notes that you are making. Then by the time you start practicing, then you spend time reading the what we call price action. That is the chart. You spend time reading charts so that you can understand what price action is doing. By the time you are familiar with structures, you just open your chart, you know the current structure, and you know when to enter and when to exit. This is the reason why the market makes an impulsive move in the direction of the trend and retraces before it makes another impulsive move. Like as I told you, impulsive move, then retracement. Then the impulsive move again will always go to the direction of the trend. So it's like that. But by the time you see otherwise, it shows that there is a change of character. And before that will happen, there must be a pattern, candlestick pattern, to tell you, to alert you that there is a change of trend. So that is how it is, guys. It's very simple. How to identify the beginning of an impulsive move? How do you identify the beginning of an impulsive move? You are to master drawing support and resistance level before you will be able to identify these areas. You need to master how to draw support and resistance level. It's very, very important. Now look at these pictures here. You see, this is an impulsive move. This is a retracement. This is an impulsive move. This is a retracement. This is an impulsive move. This is a retracement. Like this, like this, like that. So you see, this place is what we call a resistance level. Then here, this place is what we call support level. We should be very conversant with it by now because I've explained time without number. The downside is always where we call support level. The upper side is what we call resistance level. Not just any upper side, not just any downside, but there has to be more than one touches. Now, there was an impulsive move. It gets to this point, there was a rejection, it retraces. Now, it makes another impulsive move to this point, there was a rejection here. That means the price action turned from here, it reversed from here to this point. And as soon as it gets here again, there was a reversal. There was a reversal pattern here. It now made another impulsive move. So we have one, two touches here. We have one and two touches here. So this very one now, see, it made another impulsive move here. It retraces to this point to test this resistance level again. It now move again to this point to test this resistance level. It came down again. It tested this resistance level. It moved from here again and it tested this resistance level. Now, what you understand here now is that the resistance now becomes support here, because look at it. It moved from here. There was a rejection. It got here, there was a rejection. It got here, there was a rejection. So this place is valid as what we call support level. This side, this level is valid as what we call resistance level. Now, this impulsive move, there was a break of structure. It has violated this level. That means this level is no longer valid as a resistance. There was a very strong impulsive move, and when it retraces, it started forming another support level here. So this place is no longer valid as a resistance level. Now it becomes a support. Why? Because once it got to this place, it reversed and came here, and there was a rejection here again. It went up. You now see, it's forming another structure. It started forming another structure here. This structure is no longer valid as a resistant level. It's very easy to understand, guys. So here, what you need to do now, as soon as this thing forms, so you just take your tool and draw a what you call, you just draw a line like this, support and resistance line. You just draw it like this. You connect these levels together. So if you move it to the future, you discover that if this price action should make another move, is two ways. It's either it breaks this structure or it comes back to retest this level again. So what do you need to do? As soon as, now that he has gotten here, before it will return back, let's assume if there's a reversal, it will show you a pattern here. A pattern will show you that will signal a reversal. It does not just move. It will show you what we call pattern. Pattern will form here. Candlestick pattern will form here. That is to tell you that there is a reversal to the downside. So what you need to do is you enter from here, then you short the market, you sell to this. Once you enter from here, you make an entry here, your stop loss will be above this resistance level, then your target will be the next support level, which is here. You place your target here. You place your target here. Even though the price action is planning to break through this structure down and to retest this place, what you need to do, as soon as the price action gets to this place, you take your profit and wait for formation of a pattern that will signal a continuation. Once it signals a continuation, you enter again and short the market. You sell, and as you place your entry here, your stop loss will be above this support level. Then your target will be at this level. So as soon as it gets here, it will hit your profit target. Then if the trend, we have to continue downward again, further downward. As soon as it gets to this support level, it will always, price action will always respect this level. All these areas that you see like this, as soon as price action gets to this area in future, anytime, it will always respect this area. What do you mean by respecting this area? It will get to this place, there will be a pause. Then you will now see a little retracement to show that it has respected this place. Then you will now see a formation that will now signal a continuation or a reversal. I hope it's very, very clear. So you will learn how to connect this level together. You learn how to connect this level together. So, like I told us, it must be more than one touches for it to be valid as a resistance level. It must be more than one touches for it to be valid as a support level. So that is how to trade a trendy market. In trending market, support and resistance are formed from swing points. These are swing points. Move like this, form here. It comes down, it will form another one. Impulsive, it will form. Resistance, retracement, it will form like that. But as we continue like that, it will break this structure and it will go up and form another structure. And again, in future, it will go up again and form another structure, or it will come down again and form another structure. So that is how price action moves. Uptrend. The previous, no, in case of an uptrend, a trendy market, an uptrend, bullish market, the previous swing point will now act as a support level. You now see a resistance here is now becoming a support level. Is now a support level, then this resistance level will now move upward. So let's assume it breaks this structure again. This place now will now become a support level. Then the other one will now become a resistance level. But in the case of downtrend, the old swing point will act as a resistance level. So you flip the coin. If you flip the coin, you now discover that if the price is coming down like this, it will come down. Impulsive retracement, impulsive retracement, impulsive retracement. So this side now, the old swing, in the case of a downtrend, the old swing will now be acting as a resistance level. That is how it is, just like this one. The support level will now be acting as the former resistance level will now be acting as a support level. Guys, I hope you guys are getting value from this. You know, these are very, very key issues that I'm discussing with you guys. Don't ever take it for granted. If you have interest in becoming a professional forex trader, all this video that I'm uploading, just get a pen and a paper, play this video over and over again until you really get the understanding. Because it's normal, once you are stepping into a new field, it is always difficult to understand the terminology. So if you see, I don't just blow grammar. I don't just use hard, the terminology. If you say a resistor is just like a ceiling. You have something you get to, it will come down. It's like a ceiling. A support is just like floor. So I've explained to us from the beginning. I will simplify everything for us to understand. So you guys hit the like button if you have gotten value, share it to your friends, and I encourage you guys, if you need one-on-one coaching, like I've already gotten some students, I was contacted and we have agreed. So what I do is, I created a platform where I give them one-on-one coaching, one-on-one coaching. So I explain in that, I will explain even furthermore details for you to understand, because this one now is between you and I, one-on-one. I will be coaching you. Then at that point you are very free. One of the advantage of private coaching is that one-on-one you will be able to ask me direct question. You will be seeing me, I will be seeing you. You have your paper and your pen. You'll be asking me questions in real time, and I will be dissecting all those questions to your understanding. So you guys, if you want me to coach you one-on-one, my email is there. You send me an email. I will, so that we can plan on how to start. You know, trading Forex in the Forex market is very easy. You know, I will tell you guys, by the time you learn it, you keep it real simple. You don't need to, trouble yourself. Do your analysis very well. Use confluences, a different tool to prove your point, to be very sure. Then you place your trade, close your computer, and go jogging or do any other thing. Or even before you go to work, your traditional work, you just do some analysis, place your trade, and you go to shut down your computer, you go to work. The system will do the rest for you. So that is just how it is. On this note, I'm going to be stopping here. I hope you guys have gotten value from it. I see you guys in the next episode. Thank you guys for your support. Share to your friends, and all the videos that I've been uploading, watch all, because there must be something you are going to get from it. My video is a very qualitative video. This thing that I'm giving you guys is something that I struggled for. I paid for it. I struggled and I paid heavily for it. But at the end of the day, I came out very strong, bold, and very skilled. So I am not just giving you this. This is what I do. I have my job, but I trade. Right now, I don't just struggle for it. I just do my analysis, place my trade, and I go to work. So it's like that. So thank you, because this is another source of income. We don't just depend or rely on just your salary. It can never make you financially free. I tell you, you know, this is something you will do that will, attract extra incomes to your pocket, into your pocket rather. So I urge you guys to take this thing very seriously. And if you have any question, drop it at the comment section. If you want me to coach you one-on-one, send me an email so that we can plan. I already have students already that I'm lecturing. So, and I know that with the sections we've had, they know they are very, very happy, and I want you to be part of it too, so that you'll be happy as well. It's not difficult, it's not complicated the way you hear about, you see it, it's not complicated. I will promise I'll make it simple for us. So on this note, I will see you guys in the next video. Thank you. Bye.